In delivering the much-anticipated 2023 budget, Finance Minister Ken Ofori-Atta confirmed the obvious. He officially unmasked the nature of Ghana's debt portfolio. According to him, Ghana was at a high risk of debt distress, and the debt levels were unsustainable. Unlike our 16th enrollment in 2015, Ghana's unsustainable debt position was certainly a huge obstacle in obtaining an IMF deal. This means a lot of conditions must be met. According to the fund, in cases where the country's debt is assessed as unsustainable, the IMF is precluded from providing financing unless the member takes steps to restore debt sustainability, including seeking a debt restructuring from its creditors. IMF's message was very simple: restructure your debt or no bailout package. Ghana was out of the Eurobond market, and IMF looked like the only option. No more foreign grants, and at this point, debt restructuring looked inevitable.
As a middle-income country, you will be weaned of, we were being weaned of grants. You saw the slide? Yes. And we'll be weaned of concessional finance. Actually, I was the minister who, would I say, under the what, to receive the letter from the World Bank and the African Development Bank telling us that we had become a middle-income country. We couldn't borrow and repay over 40 years. We could only borrow and repay over 25 years.
After considering all the conditions and the precarious nature of Ghana's debt portfolio, Ken Ofori-Atta in the 2023 budget hinted government was planning to carry out a debt treatment to create enough fiscal space for a $3 billion extended credit facility bailout package from the Bretton Woods institution. Investors began to doubt the earlier assurances given by the president, and subsequent happenings heightened their fears.
No individual or institutional investor, including pension funds, in government treasury bills or instruments, will lose their money as a result of our ongoing IMF negotiations. There will be no haircuts.
Prior to this assurance, government had borrowed heavily from the domestic market, and the domestic component of the country's debt stock had reached an unsustainable level.
All the deposits and things that are there, unless government significantly increases interest rates, which would increase the cost of borrowing. Remember, compensation plus interest, and throw the budget into complete, they are not going to get the money from the domestic market. The non-residents who were buying our bonds exited a long time ago. It's in the 2020 budget. We are in the 2020-21 budget. It's there. Bank of Ghana has said it. So the non-residents backed off and went long ago. They were helping to deepen the domestic market. And we know it, right? It's on your websites and others. Government is not able to borrow from the domestic market all the money it needs. Either it offers higher or it cuts.
President Akufo-Addo's big assurance of no haircut brought enormous relief to the investor community. Little did they know that they were in for a big shock of their lives. Barely 5 days after the finance minister confirmed Ghana's decision to carry out a debt operation, an international credit rating agency, Moody's, dropped Ghana's long-term sovereign bonds rating to deeper junk territories, bringing the number of downgrades and revisions to at least 7 in 2022 alone. For Professor Bopin, the investors were skeptical about the president's assurances.
Stanley, the market knew the president wasn't speaking the truth. Right after the president made a statement, the reactions were more or less to reject the statements. Okay, and therefore, my expectation is that any investor who probably took a decision on the back of that wasn't an investor, was probably a lotto doctor.
Then came the biggest announcement in 2022, less than 2 months after the president had urged investors to ignore any information of a possible haircut. On 4th December 2022, the government fulfilled its sovereign component of the bargain. It finally announced a debt operation called Domestic Debt Exchange, which outlined the nature of debt restructuring for domestic creditors. Finance Minister Ken Ofori-Atta revealed the program was to invite holders of domestic debt to voluntarily exchange approximately 137 billion cedis of the domestic notes and bonds of the Republic, including ESLA and Dutch bonds, for a package of new bonds to be issued by the Republic. At this point, investors intensified their search for answers. Was a promise of there will be no haircut, just a way of calming nerves, or another clever way to swindle investors?
Why can't you be very specific and tell us that if you don't participate, you lose your money? Then some of us will commit suicide rather than go through the pain.
Oh, please don't contemplate that.
I'm 66 in March, my brother or my son. I'll be 66. And there are so many people. Maybe I can survive, but I know friends who work in the public service who are doing nothing presently. All the investment are out there, and you're telling them without interfacing with them on one-to-one or giving them information that take it or leave it.
Organized labor was the first group to taste government's pill of disappointment. Government had decided to include pension funds in the debt treatment. The group had to fight government for weeks to exempt them from the program. Other government assurances to investors couldn't stand the test of time as government made a sharp U-turn on December 23, 2022, putting the hopes of individual bondholders into disarray. It had revised its decision to exclude individual bondholders in the debt exchange program. An amended clause contained in the legal document governing the program revealed that the type of investors that can participate in the invitation to exchange had been expanded to now include individual investors. This came as a big shock to these persons holding government securities in the form of bonds. Like most investors, they had relied on both President Akufo-Addo and Finance Minister Ken Ofori-Atta's assurance of an exemption. President Akufo-Addo had information at his beck and call. He has speechwriters and researchers who have the responsibility of helping him deliver accurate information. The president read from a prepared speech. So why would he get it so wrong?
He read from a prepared speech. How could he get it so wrong? But it's been a year since the government introduced its domestic debt exchange program. Now, this was done purportedly to protect the economy and enhance the capacity to service our public debts effectively. It was met, like we all recall, with very stiff opposition, for which reason there were some delays in the entire project. There had to be engagement, town halls even, if you like. But a year on, what are the lessons we have learned? This is the first time we're going down this road. What lessons have we learned? Professor Lord Mensah is an associate professor of finance at the University of Ghana Business School. He joins the conversation. We have Dr. Richmond Etuahene, a banking consultant who is behind also one of the documents we're going to be looking at today. Dr. Saad Idrisu is an economist, Louisiana Economic Development. He joins the conversation as well. And in the studio, Isaac Kofi Ejay, data analyst, in-house statistician, and more. Good morning, Ike.
Good morning, Ben.
All right. And let me also say good morning to our guests via Zoom. Prof. Dr. Etuahene. Okay. Dr. Etuahene, can you hear me?
Yeah, good morning.
Good morning. Dr. Idrisu, are you with us?
Morning. Yes, please. Good morning.
All right. Thank you so much, gentlemen. Let me just have Kofi situates the conversation right here in the studio as we get into this. And we're looking at 1 year on. And there's this, let me just give you your flowers. There's this document out, 1 year on, lessons from the domestic debt exchange and its impact on the economy. And it was authored by Dr. Richmond Etuahene, who joins the conversation, a banking consultant, KB Frimpong, and guess who? Yes, the man sitting by my side now, Isaac Kofi Ejay. To kickstart the conversation, I mean, there was the bit about the back and forth. Do we need the DDEP? At a point, it became clear we did need the DDEP. But how would we go about it? That was the thorny issue. And then there was the issue of coupons and who would get what, when, and how. That's what they teach you in political science. 1 year on, if you wanted to give me a summary, what has happened? How have we fared? Are we learning any lessons?
Yeah, of course. I think that we've learned some lessons, and it's now clear that a government's first initial, strategy to do this whole thing unilaterally did not really work. It brought a lot of, setbacks to the DDEP program. And we've always had this famous quotation from the IMF that says that, you know, performing a domestic debt restructuring is like having a surgery.
Right.
You only do it when it is necessary. And when you are doing it, you do it right for the first time. Do it right at the first time, else you come back doing it over and over again. In our case, we probably did not know what we were in for, because probably it was our first time. Nobody was actually used to exchanging debt or doing haircuts and restructuring.
Right.
So because it was in the domestic space, the government felt it could use a unilateral means to probably bulldoze everybody along, but it turned out that it did not work. We had individual bondholders opposing pension bondholders, and then also even banks and insurance companies. It took government, you know, restructuring of the terms and conditions, the MOUs, for the banks to now come along or to come to the negotiation table to participate. So I am looking at the old bonds that were actually exchanged for this particular new ones that we are talking about. So for the old bonds, we had, you know, a coupon rate of 19.1%. The new bonds, which is the one that has been exchanged, now reduce the coupon from 19.1% to 9.1%. That's a haircut over there.
Yeah.
So from 19.1% to 9.1%. If you look at the average maturity,
I guess at a point it became not about getting a haircut, but about which haircut you were going to. Whether it was going to be Punk, Sakura.
As for Punk, you were never going to get.
Punk, yeah, it was out of the question. There's no way they were going to lift you high. You would, but not even with Punk, they shave the other sides and then they
leave the top. Maybe some people got that because remember that in the final announcement given by the finance minister, we saw that some people were excluded from the DDEP.
Curiously.
Exactly, and that cost us about 40 billion Ghana cedis. We said that some people were not eligible to participate. Others were allowed to exchange their bonds for treasury bills. All of those people, if you quantify, we looked at some 40 billion Ghana cedis that we had to let go because of this exclusion, you know, thing that we did in 2022. But I was talking about the average maturity period of the old bonds that were exchanged.
Right.
3.8 years. Now the new bonds look at 8.3. So just look at it. 3.8.
About 5 years.
So it's just like you swap the figures. So 3.8. The new one is 8.3. The coupon rate, we've spoken about it, 19 to 9%. But let's look at the participation rates of the bonds that we are talking about. The general participation rate of government was around 85%. But if you look at the final exchange document that was presented by the finance minister to the investor community, you will see that the participation rate amongst treasury bonds, ESLA bonds, you know, Dachi bonds were around 91%. There was another one, 95%, US denominated local bonds. So the investors who came, the foreign investors who came to our you know, our space, our domestic space to come and invest, buy bonds, were also given a haircut. The participation rate there was 92%. Cocoa bills, you know, 97%. And then we also have the non-marketable debt held by Bank of Ghana. Can you imagine? 100%. It means that everything
went to them.
They
took the hit.
They took the hit. I mean, if you do the revised DDEP, you know, the impairments, you see that the Bank of Ghana probably took a haircut of more than 50% in this whole debt restructuring that we are talking about, Ben.
Let me come to Dr. Etiahene, because you actually partook in this research piece. Doc, so looking at this DDEP as a banking consultant, a year on, even before we get into any lessons that may have been learned, what would you say has been the gains that we have achieved, have been the gains that we've achieved from the DDEP so far? And are we at a place that you would have expected we would be, economically speaking, on the back of the DDEP?
Thank you very much. I think we haven't reached where we're supposed to reach at all. I think it's the year on, and the ramification or the implication will not be felt as at now. But if you look at the figures, how the figures has been changed and changed, I think for 3 times or 4 times, the whole debt restructuring has been changed. And you realize that initially, the banks were going to suffer a major haircut. That was very, very dangerous. And I think after Marrakesh, the minister decided with his consultant, financial consultant, decided to relook the whole thing again. And they came up with these, the last bit of shifting of the goalpost, which means that the banks have now actually been relieved a bit of it. The serious charge, as Isaac said, is on the Bank of Ghana, cocoa bills, and then the foreign denominated bonds. But as to say we have reached the point, we haven't, because literature has shown that any debt exchange that do not back up with a deep fiscal consolidation, what I mean by fiscal consolidation, trimming the budget, trimming the government expenditure, reducing it to the barest minimum. If we don't take care, as happened in Jamaica, 3 years after they did 2010, by 2013, they had to face the same bullet again. So I would prefer that government would take a critical look, reducing the expenditure to the barest minimum. But what did we see last, maybe not long ago? We have a public sector salary wages of 23%. Well, these are all having a physical implication for the budget. So maybe the government would have to look at their own expenditure, reducing the numbers, cutting down so many things so that we'll be able to meet the other aspect of it. Because debt exchange is not only about that, it's about also physical discipline. And we have never been physically disciplined. And my only worry now is that as we enter into the election year, literature have shown, results have shown for 2008, 20, all the years that we have elections, we have had a spillover. We haven't been able to maintain the 5% of physical discipline that we talk about. So I'm wondering how we're going to achieve this. And if not, that is not the end of the road. I'm not predicting it. But if we don't keep the physical consolidation to the barest minimum, we will come back to this table once more, maybe in a year or 2 years' time. That is what I will say for the time being.
Just a quick one, because you say that we've never been fiscally disciplined, especially in an electoral year. If memory serves, in 2016, it's been touted that we actually did what had to be done, especially on the back of an IMF program. Is that not correct, Dr. Etiahene?
Well, what I know is the first one, I mean, if you let us go back to last year, we have it about 11 point something before we went to 15.8. What I remember during the I've forgotten the years, most of the years, 2016, I don't think we achieved the 5% discipline that we were talking about. I don't know where it's coming from, but if you look at the years that we've had these elections, we haven't been able to achieve the set target of 5% that we set for ourselves.
Let me come to Professor Mensah now. A year on, we've had, a year on since embracing the DDEP. Reminds me of this song. So we've tied, our cloths to the DDEP, embraced the IMF. How do you feel we have fared, especially on the back of what Dr. Etiahene says, that we've never been fiscally disciplined and we are entering an electoral year? How have we fared?
Okay, right. Hello.
Yes, bro.
Can you hear me, please?
I can hear you loud and clear.
Right. So we went into this debt exchange for a purpose, and I always look at it from 2 objectives. We went in there to reduce, government's, debt burden, and then also find a way to reduce interest rates in the economy. At a time when interest rate of government bonds were hovering around 21, 22%, it was expected that when we finish, debt exchange, interest rate will reduce drastically. And if I say interest rate, I'm looking at interest rate across all the maturities, including, treasury bills, and then extending it to government, long-term bonds. Now, if you look at the budget that was read for 2024, clearly you could see that the debt exchange did not feed into the budget, because in 2023, we're looking at an interest payment of around 53 billion, which in 2024, we are projecting around 55 billion, taking into consideration, what we call the foreign, debt, which has some kind of increment as a result of, foreign exchange depreciation and all those. Clearly, you could see that, the debt exchange, which I was expecting that after a debt exchange, your interest payment will reduce drastically. We did not see that. And so effectively, the impact of the debt exchange on our expenditure is not being felt as, expected. So, and we were still in the horizon of having, a yield curve where, short-term interest rate, turns out to be so high, sometimes double or triple of the long-term interest rate. I'm talking about, government, government bonds that were restructured, which liquidity has become a problem because of investor confidence in, reduction in investor confidence in government bond. So all investors are looking at, short-term instrument, and government is also fueling it. Government is fueling it by reading budget with high expenditure, with a huge budget deficit. The current budget deficit seems to be lower than, a year before's budget, but that is more or less, a way of dribbling, Ghanaians with the numbers. Let me put it that way. I stated this, yesterday, and I'm going to repeat that. We had a budget deficit, of about 5.8, percent going into 2024, which is way below what we targeted, last year. In effect, it tells you that we're being fiscally, disciplined. We are improving on our fiscal discipline, but that is just, something to deceive, us, because we've raised, revenue, and we've raised, our expenditure, target. So effectively, that 5.8 that we see is nothing. And in a way, it tells you that government wants to spend. And any signal of spending, when you have lost all your avenues of financing, with the exception of treasury bills, even the treasury bills, investors are doing the 91-day more than the 1 year. It tells you that you should tone down your, expenditure. You have to reduce your expenditure. That is where Dr. Chiang is talking about, the fiscal discipline, which is very, very important, after your debt exchange. After debt exchange, you are not having your debt payment reduced, in your budget. You're not having interest rate, reduced. Then the question is, what is the essence of the debt exchange? Okay. What was the essence of the debt exchange?
So as you pose that question, then I would ask you, has the debt exchange lived up to expectations? Has it been useful? Has it been useful?
Not at all after the 1 year. Not at all. And I think that's the purpose of, this discussion. Not at all. You see, I was expecting that the debt exchange will correct the yield curve after we go through the debt exchange. And what I mean by yield curve is that, the interest rate structures with their maturities. When you take the short term, it needs to have lower rate than the long term, which is about, the 10%, 9% that we are talking about. We're not seeing that. The reason why we are not seeing this is that government is always on the market looking for money. And the investors' confidence in long-term instruments has also gone down. And as a result of that, the investor is always, ready to invest in government short-term instrument. And even if somebody wants to do the 1 year, he tries to do 91, wait for more information before he calls in for a rollover of 182, and then possibly, continue to roll over. So the 91 is more concentrated, and you don't grow economy with that. So I'm surprised we are even projecting huge GDP growth. The huge GDP growth we are projecting is mainly at the back of government spending. not businesses spending and individual spending, because interest rate is not coming down any moment from now. Look, we've been in this situation before. We had a situation where short-term instruments were calling for higher rate than long-term instruments some time ago. And what did we do? Because at that time we had international credibility, we were able to go to the Eurobond market, which over there were borrowing at maximum of 7 years, and the then finance minister, which is Setekwe, used to coin a term called smart borrowing. Smart borrowing in a sense that we're borrowing long-term from the international market to come and use part of the money to offset, short-term, investment in Ghana, and then we're able to increase, the horizon of the investor community from medium to long-term as a result of government shifting its demands for funds into the long-term. You don't grow economy with the kind of interest rate structures we have. And I was thinking after the debt exchange, we're going to correct that, because you can't use 1 year treasury bill to build roads. You can't use 1 year treasury bill to construct, hospitals for individual. You cannot use 1 year treasury bill to do school feeding. I'm talking about social projects like school feeding, where the returns are so in the long term. So effectively, I can tell you that this economy, as we speak now, that we're thinking after the debt exchange, we'll see some signals of improvement. We're not seeing it because all the numbers are clear. It shows on our face that, we are more or less in an economy where you cannot raise money in the long term. And every economy that you cannot raise money for a long term, that economy does not grow. So the growth projections that we are doing, I wonder where the numbers are coming from. And so I would say that, yes, indeed, we did the debt exchange. Ghanaian investor, typical investor, has suffered all right, but, we're not seeing the benefit. And
right.
You see, the cost to household, as far as this, debt exchange was concerned, was so huge. That was when a typical Ghanaian got to feel, the economic mismanagement at his doorstep. Previously, when we talked about the macro indicators, we talked about this, people think, these are, economists just throwing out numbers. But then I was telling myself that one day that the mismanagement will hit your doorstep, where you have inflation so high that you are not even sure of your salary, what it can buy in the next month. That is when you appreciate what we project into the future. So effectively, we did the debt exchange, but I can tell you that, the benefit, we're not realizing it as a result of government's posture. Government posture has been that government always wants to make money available to himself and then spend. And that is what has brought us this far. Well, the moment we moved out of the IMF program, we saw that signal. We even celebrated, the IMF, exiting, thinking the fiscal rules that we set for ourselves, thinking the fiscal committee that the president said are going to be active on the grounds to put the government in line, to check the government so that we keep the trajectory as far as, the IMF budget deficit projections were concerned. But we didn't. We went haywire. We went in our own way, thinking spending is what will grow the economy. But excuse my language, we've messed up big time. The hole that we find ourselves in, coming out will be a problem. There's no quick fix. There's no quick fix as we speak now. The only quick fix will be to look at long term how you can constantly reduce your expenditure along the line, and then sensitize Ghanaians that look, when it comes to goods and services, when it comes to capital expenditure, we have to tone down as we speak, because those are the discretionary expenditures we can control. If we don't do that and be transparent enough, trust me, we can't, come out from this, economic situation that we find ourselves.
Prof, hold for me. Let me now bring in Dr. Saad Idrisu. Now, on the back of all the borrowing that Professor Mensah speaks of and where we find ourselves, he has also made mention of the fact that, and I would just remind you, even when the finance minister was speaking on the back of the DDEP and all of that, there was this conversation where he spoke even about being able to go back to the capital market, which then sends a signal about our intent in terms of spending. But if you look at even the T-bill auctions, as of just the past month, Government borrowed 15.32 billion Ghana cedis. What signal does that paint as in respect of how far we have come on the back of the DDEP?
Thank you, Ben, and good morning again to you and your listeners as well as my co-panelists. Well, let me first say that government actually didn't plan before introducing the DDEP itself. When I say government didn't plan, at least there wasn't broader consultations with the whole idea. So it seems like government rushed into the whole implementation of the DDEP. Initially, some of us kicked against it. We spoke vehemently against that, and I even went and suggested a debt swap as alternative that the government could look at, but unfortunately all didn't come into being. And you could actually say that even as we speak 1 year down the lane, the economy is still experiencing the negative impact of the DDEP program. And Ben, as from the economic point of view, let me just show you this report. I'm not sure, I mean, it is available on the Bank of Ghana website. It is the summary of economic and financial data, November 2023. To actually demonstrate to you, or to actually show you more, I'm going to use government's own data to just point out certain things to you. If you go to page 2 of the report, it's available on Bank of Ghana, so anybody interested can literally look at it. If you go to page 2 of the report, which talks about the real sector indicators, you realize that before the DDEP, that was fourth quarter of 2022, that's December 2022, you realize that our GDP in real terms was growing at, was 48.7 billion Ghana cedis. But after the DDEP, all along till second quarter, currently as we speak, it has declined to 42.1 billion Ghana cedis. If you're looking at it in terms of the overall growth, without including the oil sector, excluding oil, the economy was growing at 4.3%. That is by the fourth quarter. As we speak, the economy is growing at 3.2%. So before DDEP, we were growing at 4.3%. That is excluding the oil sector. And after DDEP, along the line, second quarter, we are 3.2%. Now, the question is, within 6 months to end the quarter, which is the fourth quarter, or 6 months to end the year, are we sure that the economy will be able to grow to the pre-levels it was growing before government introduced the DDEP? So if anyone is telling you that DDEP has actually helped the economy, it has boosted, believe me, they are lying to you, because the figures themselves from the government-owned databases are pointing that the economy is rather declining as we speak. In terms of real GDP, in terms of real GDP growth, and in terms of even industry growth, the industries are growing at negative 1.9% as we speak, based on the data, that is page 2. If you go to the same data, page 5, the same report, page 5 of the report, it tells you about the exchange rate. Now, if you look at the exchange rate, as at the time government was doing the DDEP, the exchange rate cedi to the dollar was 8.57 to the dollar. That is December 2022. Along the line, right now, all the way to November, the exchange rate is 11.56. So are we going forward or are we going backwards? So it tells you that the DD...
But there's also been a drop. There's also been a drop. At a point, it went as high as about 16. If you're looking at even the dollar, it went as high as about 16 on the market.
I'm talking of the point the government did the DDEP. We are looking at DDEP and after DDEP, what has been the benefit?
Right. So I get the point you're making, but I'm saying that within that period as well, the exchange rate hits that high. So even if some months down the line, about a year down the line, it's at 11 point something, which I agree is still very unhealthy for everybody. Would that not be a gain?
It doesn't even compare to the December level that we had with 8.57.
Right.
All right. And if you come back to the main depth itself on page 8, that, like I said, this report is available on Bank of Ghana website. That is the November report. If you go to page 8 of the report, it clearly tells you that even with our domestic debt, as at the time we were doing the debt restructuring domestic, it was 205.4 billion Ghana cedis. Currently, as we speak, that is September, according to the report, our domestic debt has ballooned to 240 billion Ghana cedis. So it clearly tells you that we haven't actually realized anything from the DDEP program, with aside the IMF bailout that the government had. And with the IMF bailout, even with the first 600 payment that we received, you are not realizing its benefits on the economy. You are not seeing, improvement in this macro indicator. You are not seeing improvement in welfare. And you are not seeing improvement in market conditions and the overall health of the economy. Because at the point of implementing the DDEP, government told us there wasn't going to be a haircut, but at the end of the day, the banks took almost 14% haircut. The Bank of Ghana itself took almost about 50% haircut, resulting in losses in these banks. GCB Bank resulted in a loss of almost 50 million cedis. Dollars rather, $50 million according to Bloomberg. The central bank itself had a 60 billion cedi loss, right? If you are putting out your macro projections for growth, you need the banking sector to be able to solidify the growth. You need the banking sector to serve as a financier to the private sector to stir the growth that you are looking for. But here is the case, your DDEP rather collapsed your banking sector. The DDEP rather kept our banks in distress. So the banks that could have loaned out to the private sector to stir up employment, to stir up productivity, and to stir up the general growth that they are looking for, we weren't seeing it.
Right.
And with government promise of a 1.5 billion financial stability fund, as of July, it wasn't implemented. By October, the deadline came in passing. As we speak, nothing of that sort has yet to materialize. So you realize that, it seems the government itself, excuse me to say, it's not actually looking to achieve its own growth targets that it has set for itself, and even the growth targets that is putting in the IMF report and all that. Because without the financial sector, believe me, we can't achieve the growth targets.
Right.
I don't know how government intends to manufacture the figures. With a collapsing banking sector, with a collapsing financial sector, you can't achieve that. Okay. Basically, the private sector is collapsing. So, it's just unfortunate that we kind of find ourselves in an environment that people tend to rather be quiet instead of speaking up. But the financial sector is collapsing. Even with all that is happening, the policy rate is still high, resulting in a higher lending rate, higher cost of borrowing. So how do you promote macroeconomic stability?
So that's the question. That's the question we're all trying to wrap our minds around. Let me get to Dr. Etiahene, because there's also the talk about the hit that our central bank took. Yes, the other banks took lots of heat from the DDEP and other, structural imbalances. But the central bank itself, in cushioning government, in cushioning the sector, because it is the regulator, took quite a hit of about 50%. And I just want to find out from you, what does that mean for our central bank by way of effect, really, in this economy?
Thank you very much once again. And thank Professor Lord Mensah and Dr. Idris. I think what they've all said is true, because currently, as Professor Mensah said, there is a crowding out in the system. The private sector is not going to grow at all, because, like, if you listen to Prof. Mensah, what he said, and what Dr. Said said. But let me come to Bank of Ghana and what has happened to it. I think after the first DDEP, about 3 times they did, which I have followed critically with my research and reviews and the quantitative and analysis that I have done. I think they realized that the first DDEP, the banks took a hit. At least first there was 41 billion. They revised it to 30 billion. And then they realized that the way the shareholders, especially the international the bodies from South Africa, from England and Nigeria were complaining of recapitalization. I said they came back again and they did this last review, which has reduced the impact from the banks of 41 and shifted that impact basically to Bank of Ghana. So the banks are now going to suffer about, if you look at it, it's about 7.3 billion. And the Bank of Ghana is going to take the hit of that 34 billion. And that would, people will say that policy stance. No, I agree with them that it's not insolvent. But if you look at it critically, the literature clearly says that it will affect monetary policy regime. It can even affect the lender of last resort, whereby you give emergency liquidity support, or when we do the repurchase agreement for the banks, because most of the asset with them has been actually been reduced. So when people say that it's not going to affect the banking sector, maybe supervision, maybe. But when you come to the areas like lender of last resort and the purchasing agreement we have to do when one is in trouble, it is going to affect the banks. And we have to agree to it. And that is not the story alone. If you look at the losses, it will take such a long time for Bank of Ghana to do a retaining of profitability to be able to bring the banks to in the profit levels. And if the banks decided to go to the government to borrow, to government for support, then the fiscal discipline would also come to there. Then the government would have to go about the fiscal life. So we are torn between, I won't say the devil and the angel. We are torn seriously. People say it's nothing. But you see, we have been very fortunate that there hasn't been rundown. Liquidity is flowing around because of information asymmetry. One thing about Ghanaian banking sector or financial sector, there's information asymmetry in it. What I mean is that people are not financially literate. So when Dr. Samed was saying, he said that people do not, Professor Menson said that people do not understand. If people get to understand what has happened, there would have been a serious thing. And if there was a serious rundown, what would Bank of Ghana do? So the losses have fiscal implication. It has also some policy implication. The role that they have to play when they're critical, because today, if about 7 of the banks decide they don't have liquidity and they go to Bank of Ghana, I'm wondering whether they will be able to do that because they have the asset actually impaired and eroded. So the asset has been reduced. How would they be able to support? Those who say that must also look at the physical aspect of it. You see, when you make losses, it's either you have a good retainership, when you retain more profitability. But if you look at Bank of Ghana figures, it will take them years and years if they want to maintain their profit. They definitely one day will have to go to the government for support. Other than that, it's good in the eyes of them. But what is it? It also has a reputational issue. The reputational issue where people don't understand is that Bank of Ghana does not keep correspondent bank relationship in Accra. They keep it with Fed. They keep it with Bank of England. They keep it with the Bundesbank. These are the banks that hold your foreign reserves. And if you yourself are not good, can you ever even begin to do businesses with you? People should have these things in, because literature says that it has some implication for the central banks. And I hope they will appreciate it and they won't say that people are speaking against them. These are the people who have seen it before and telling us, and we should be able to appreciate some of the things that some of these people have been saying. So they can say it is nothing, but like Professor Menzo said, and Said said, in Ghana, when you speak about it, you either one or against them. But these are the real issues. These are researchers. These are people who have studied it and read literature and confirming what the literature has said. It has happened to other countries. So when we are saying it, we are saying it with a good intent, not any malice.
Dr. Chiane, hold for me. Professor Mensah, before I come to you, very briefly, Kofi Ajay, I just want you to walk us through. So Ghana's debt after the DDEP, before and after, if you like. And then let's look at this. There was a lot of talk about how the DDEP would impact the private sector, how it would crowd out the private sector in terms of staving it or starving it of funds. what do you see a year on? What is the picture on the back of those?
Well, so let's use the same data, the summary of macro and financial data produced by the Bank of Ghana, this very recent one in November 2023. And we are looking at the country's total public debt when DDEP took off and now. So it was December, around the same period that we launched the DDEP. The time that we did launch the DDEP, our debt was 446.3 billion Ghana cedis. Now, if you look at it, 10 months on, we are looking at a debt portfolio of 567.3 billion Ghana cedis. It means that after the DDEP, we've added more than 121 billion Ghana cedis to the public debt stock. If you convert to dollars using $1 to 10 cedis, we are looking at about $12 billion in a span of just 10 months after DDEP. Now, because the DDEP focused on the domestic debt, let's look at the domestic debt as at the time that we were doing the DDEP. It was around, 205.4 billion Ghana cedis, just like Dr. Saad Idris said. Now, 9 months on or 10 months on, we are looking at 240.6 billion Ghana cedis. That means government has added more than 35 billion Ghana cedis, which is about $3.5 billion in a span of 10 months after it did the DDEP. Also, you spoke about the impact on the private sector. Let's go to the MPC document, the press statement that was issued by the Bank of Ghana, and see what the DDEP did to the private sector. So I'm going to read verbatim. It says that credit to the private sector contracted during the review period. It says banks continue to deploy their resources towards short-term investment, just like Dr. Lord Mensah said. Banks continue to deploy their resources towards short-term investment. It means that the banks are now going after treasury bills, Ben. If banks are going after treasury bills, it means they would like to put their money, buy government papers or bonds. They will not lend
instead of giving to the private sector.
And you see, Bank of Ghana said it. It says that they are deploying their resources towards short-term investments as opposed to extension of credit in response to the increased risks associated with lending following the deterioration of macroeconomic conditions and the impact of what the DDEP. This is not my own words. This is according to Bank of Ghana. Now listen to it. It says private sector credit contracted by 7.5% in October 2023, as against 57.3% growth recorded in the same period in 2022. So in the same period in 2022, the rate at which banks were giving, commercial banks were lending to the private sector, the growth rate was a whopping 57.3 percent. Now you are looking at a contraction of 7.5%. So to move from
far less money.
Exactly. To move from a growth rate of 57.3 to a contraction, a negative 7.5%.
That is a whopping figure.
Exactly, in a year. And this is according to the Bank of Ghana. It's in the MPC press statement released on this same month, last month, exactly.
It'll be interesting to find out how this has impacted business.
Exactly. So,
really?
Well, if the Bank of Ghana is telling you that there's a contraction in the private sector in terms of the flow of capital to them, it tells you that individuals are now borrowing at a higher cost. I'm not sure.
You're looking at around 40% plus.
Exactly. If you go to the bank,
40%.
If you go to the bank, maybe the least loan, interest on loan you can get probably will be around 31 or 30%. People are even now paying 35, 38, and it's in the range of
because after they use the standard rates per the Bank of Ghana, they have to add on their percentage of about 7%, depending on
the market.
So once you add that, you are looking at something close to 40%.
So if government is issuing treasury bills around 30% or 29% interest, and it tells you that the banks will also add their margins, their marks to it when they are borrowing to you. And it's in the Bank of Ghana statement that they are now they now want to, put their monies into short-term securities. I mean, they are going after the 91T bill, just like Professor Lord Mensah said.
So there's a clear signal. The writing is on the wall.
Exactly.
Professor Mensah, what is your quick response to that? There's something else I want to run by you, but how do you react to this on the back of the stifling environment when it comes to private business? They are being crowded out. Some of you spoke about this, you foresaw this, and it is indeed happening. And then Ghana's debt post the DDEP. Does that make any sense?
Yeah, so it doesn't make sense. I mean, like I mentioned earlier in my submission, government posture is the order of the day. The posture has been that I want to spend. That aggressive trajectory that government has been on in terms of expenditure, increase, it has not toned down after the DDEP. And that is why you see more money flowing to the government than, the businesses. Of course, the cost of borrowing is one of them, at the heels of, huge inflation, on the market, because we're talking about inflation looking around 30% and above. So no one will lend to an environment where the risk is high as a result of even the macro structure that we have as we speak now. They know very well that the economy is not good. When you lend to the private man, it will be difficult to, retrieve your money. They know very well that, things are not that good. But you see, surprisingly, in the news recently, they said the banks are posing profit. And then I asked myself, where is this profit coming from? It's mainly, investment in government instrument, treasury bills. And you see, the adding up of the debt that we've compared since the last 9 months, as Kofi threw out the numbers, about 35 billion, are in short term. That's the worrying aspect. They are in short term. The government knows very well that the investor appetite has reduced from long term to short term, and they're still fueling, the investors' appetite to still remain in short term. That is not how we run an economy. Because at the end of the day, you have to give the signal. And let me tell you, that in the funds that are flowing in the system, right, has no alternative destination than government instrument. Government can come up one day and say, I'm borrowing at 19%. They will still get their target because the funds have no alternative, investment destinations. People's appetite in financial instrument has grown. People are lazy now. They don't want to put their money in farming. They don't want to put their money into, mini industries that they have to stress themselves managing it. So giving the money to government to work with has been the order of the day. Government can get up one day and say, I'm reducing my borrowing rate. If you think you can find it somewhere else for the money, go and do it. And they'll still attract the necessary funds that they need. It's the government that has been fueling this because they want to stay on the market, competing with the private sector, knowing very well that when the rates are high, monies will find itself into the bosoms of the government rather than, individual businesses. So from what I said, it has to do with control. When you look at what we call the loanable fund theory, businesses are demanding funds, governments is also demanding funds, individuals are demanding funds, but when interest rates are high, monies will find itself, with the government. But the same bank that is posing profit, the same bank is also calling for, high non-performing loans. Okay? And where is the high non-performing loans coming from? Because of the interest rate levels. Anybody that is borrowing now and operating within this economy, the tendency to pay at that high level of interest rate is very low. So the level of interest rate itself is causing, credit risk problems. So from where I sit, I think the government needs to change its posture.
All right. Hold for me. I'll come back to you shortly in a bit. But let me also bring in Dr. Edu Ananai-Entry, convener, Pensioner Bondholders Forum. Interestingly, on the back of this entire conversation, something we've put on Joy News on Facebook, you can check it out. In recent times, Mr. President has been speaking. He says, despite the challenges confronting the nation, we have demonstrated with our record in office that we are the party that can bring progress and prosperity to all parts of our country, including the economy. From where you sit, pensioner bondholders, and what you see out there in terms of our economy, in terms of your purchasing power, in terms of inflation. Are you seeing this progress and prosperity?
Well, thank you very much. I think what I can say is that, and everybody is aware of that, is that the government is now paying coupons and principals when due. If that alone is what is leading into prosperity, I cannot vouch for that. What I can vouch for is that government is paying. But the fact that government is paying the coupons and the principals when they are on maturity, does not mean that we are heading towards prosperity. That I cannot vouch for.
I just heard Professor Mensah saying in the background that they are paying the coupons with treasury bills. And of course, that has its own implications as well.
Yes, that is all that I've been saying. If you don't have the money, you would only have to borrow new funds to pay the old funds, because we are not generating sufficient money to
basically
reduce our debt.
Economically speaking, that is robbing Peter to pay Paul.
Well, we can't say robbing. You owe, you must pay. You don't have the means of generating income to pay. So definitely you borrow and pay. And you see, when you are borrowing at higher rates than what you are paying, then you have a challenge. And that is why I always have a problem that, why can't government look at these rates? There are only we call them primary dealers, those that have been licensed to buy these treasury bills on behalf of clients. Why can't the ministry have a discussion with them that, look, we cannot be selling treasury bills to you at this rate. Let us come down. No investor, as far as I know, no investor goes to the bank to order for treasury bill and state the interest rate that he wants or she wants. No investor. It is the primary dealers who go to the market and say, we want to lend to you at this rate. And if government continues to borrow at that rate, I have a challenge. And as someone was saying, these funds do not have any other sources or avenue for investment, save the government bills. So why would government still continue to be borrowing at that high level when you can say, look, I can't borrow, I can no longer continue to borrow at this level? Try it and see whether people will say they won't give you that money. Where would they take that money to?
They will still get it.
And so you will still get it. So I can't understand. The other time I said to your friends that, look, for me, I think that government should just meet these primary dealers. And these are all the banks. They are the primary dealers. No investor individually goes to the option market. It is the primary dealers. So just having a discussion with these primary dealers that, look, we cannot sell treasury bills to you. We cannot borrow from you above this level. What would the primary dealers say? Would they take their money to Nigeria, or they would take it to Togo, or where? It will still be in this country, and they will have to invest it.
Yes, but what will that also do? What will that have as a ripple effect? You must consider that as well.
No, what ripple effect? If interest rates come down in this country, what ripple effect?
I'm talking about the confidence of the very market and the very people government is lending from. Government is borrowing. Government is borrowing from, I mean.
Yes, we know inflation is high. But we can't always get returns that will beat inflation. It's normal, under normal circumstances, you want to have something higher than inflation. But this economy, I remember some time ago when inflation was about 70%, treasury bill was at 45%. So we have had these challenges before, that interest rates are lower than treasury bills. And we move on. But I'm saying that, you see, why was government able to bring this treasury bills rates down? And we were all involved. We in some of our discussion, we told the ministry that, look, you should try, and if you say you are not borrowing that much, and you have some cushion, definitely you can force the interest rate down. And I'm saying there should be a conscious effort talk to all of us. Nobody, no investor, if you go to the market now and the primary dealer gets you 20%, no investor will say, I won't put my money there.
Right.
That is a fact.
Right. Quickly on this point, very briefly, before I move on. So you, the pensioner bondholders, you're getting paid now, your coupons, your principals and all that. Yay, it's a good thing. We all know where that is coming from. Whether that's sustainable is another question. But your purchasing power on the back of this economy, on the back of the DDEP, what has that been like? And the other metrics of our economy, what will be your quick reaction on that? Because that directly impacts you as well.
Yeah, as for the purchasing power, it's eroded. It's eroded because if you have your inflation at 40 and you are even getting your coupons at, let's say, 25, some of them 19 and others, you are still a handicap. You can't use the interest that you get. You can't use it to purchase goods and services at this current prices. So as for that, it's just you are just redeeming part of the loss. Otherwise, everybody is hanging around just like that because of inflation. But I'm saying that now it's okay because you get the money. But as to whether, and that's why I say, after you have gotten your money, if that is what is going to lead you into prosperity, I can't vouch for it because you get this money. And when you go to the market, the interest rate that you have gotten on your bonds is not able to fight the increases in prices. So that one, everybody is affected.
Dr. Idrisu, as we get ready to wind down on the conversation, I want to start situating lessons. If you look at the tail of the tape, if you look at our inflation, if you look at the interest rates, if you look at government's over-reliance on T-bills, if you look at all the other metrics we are seeing, the gargantuan increases in borrowing post the DDEP. If you look at where we find ourselves in terms of even getting the second tranche of the IMF money, if you look at all of these metrics and more, where our central bank is currently, its own constraints, what lessons do you feel, if any, we have learned and are applying from the DDEP and maybe we could learn or should learn and apply? Dr. Idrisu.
Well, as to whether the government has actually learned its lessons, that is another topic for discussion another day, because if we are not careful, we may be coming back again for another DDEP, probably 1 year or a couple of years down the lane. Because if you look at history, or if you look at countries that has implemented the DDEP, for example, Jamaica, the first one wasn't successful due to how it was implemented. And I think about 3 years down the lane, they had to come back for a second DDEP. But the lessons that I would want government to actually learn basically is that the economy is in various sectors. Government has a role to play, and government role should not crowd out the private sector, basically. I think governments or successive governments as well should be able to learn this. Whatever government is doing in terms of job creation, in terms of development, whatever it is, unless the private sector is needed as the engine of growth to be able to stimulate the needed jobs in the economy and drive the growth that government is looking for. Without the private sector, we wouldn't be able to achieve any meaningful growth within our economy. And the financial sector is needed to be able to drive that. So I think government will need to learn this bitter lesson and see how to be able to fulfill its own promises it has made to the financial sector following the DDEP. That is the $1.5 billion Ghana Financial Stability Fund. I will be happy that government focuses on it, unless whatever money that it will be raising, because I think the World Bank gave 250 million commitment, and I think the African Development Bank also gave, I'm not sure whether it was 100 million commitment or so, but the rest is yet to be raised. Government needs to focus on that. With a thriving financial sector, definitely the cost of borrowing might be able to come down, and the private sector will also be able to come on board. Because no matter how government wants to create employment, it will not be able to satisfy the teeming unemployed youth, no matter how it is. Because if you look at, I think government employs about 23 or less than 30% so far. So it is the private sector that creates the jobs. And if you don't support the private sector, definitely you are going to have a weaker economy. And aside that, it's good that government spends on social services like the LEAP, but in our part of the world, excuse me to say, the beneficiaries are not even the actual beneficiaries. So at the end of the day, the needed development that could have been inured from that is lost, because at the end of the day, you have political cronies, political friends being beneficiaries of these LEAP services. So even if government is increasing it in the budget, does it really go to the poor and needy in the society who needs that? Those are the stuff that government will have to look at. And for a successful DDEP, government will actually have to focus on cost reduction. Expenditure reduction is very necessary. Look at the recent climate change conference happening in Dubai. I'm not sure whether the rumor is true, but news coming out is suggesting that government has sent 618 delegations just to represent Ghana. At least think about all the expenditure associated with that. Their per diems, their efforts and all that. So stuff like this, if the rumor is actually true, government will have to actually look into cost expenditure reduction in some of these stuff. It's not expenditure reduction in terms of building hospitals, not expenditure reduction in terms of providing social amenities, but expenditure reduction in terms of some of these travelings. It will be a better way to be able to, propel the growth that government is looking for.
Dr. Etuahene, you have, put on paper some of these thoughts on the lessons on the back of the DDEP. Has this government, has it learned? And if not, what are some of the lessons we can take away from the economic situation we find ourselves in currently? Dr. Etuahene. Hello, Dr. Etuahene, are you with me?
Yeah, thank you. Thank you very much. Hello?
Did you get the question?
Yeah, I've got the question.
Please go ahead.
Yeah. I think the lesson that we have learned from this whole DDEP is that the country, as a country, we need to put a brake on our debt. There must be a conscious effort to put a fiscal, what we call the debt cap or the debt limit in our an amended constitution. Because what we see here is that the borrowing becomes a soft spot for people who promise heaven and earth when they come to power. And then when they borrow, the money do not go into productive sectors. What I mean by productive sector, when this government took over, cocoa we syndicated 2 billion. Today we're talking about 800 million. If all these monies that we borrowed, especially the foreign aspect of it, should have even gone in rice production and poultry, we wouldn't be spending 2 billion in that area. So I believe that as a nation, we should all come together, the CSOs, the government, the politics, everybody, so that Ghana must make a conscious, put a debt cap in our constitution. We should go and amend the constitution, because the way it's going, we will revisit these issues on and on and on until death do us part, because people promise heaven and earth when they want power. But the heaven and earth comes from the revenue you generate. One belongs to the revenue you generate. Now, let me give you another example. Look at cocoa. Look at gold. People talk about gold. Recently, a minister said we generated 6.6. But from Bank of Ghana's own report, 2022, Ghana received a dismal 865 billion, not 6.6 billion. What are we doing? What sort of contract are we signing? All these things had impacts on our generation, our social infrastructure and economic infrastructure. How can you export 6.6 billion for a country to benefit only 865 million? It is a big disgrace. I don't know which contracts we signed. Let me give you an example. Recent, as this at the beginning of the year, Botswana said no. De Beers who have been doing diamond has been doing what they've been doing to Ghana. They say no. Either you renegotiate the contract, move us to 30% and 40%, or leave the resources down. The De Beers have no objection. They had to do it because they need the diamonds. Why are we selling everything and destroying everything?
Right.
So for me, we should put a debt cap, and we should be managing our resources effectively and be sure the contract people sign. You talk about lithium or what have you. You read and some of the comments you hear from IAE and the former Chief Justice, you begin to ask yourself, are we doing justice to the country and for the future generation?
Right.
The future doesn't belong to the old. It belongs to the generation behind us. Why are we rippling it, borrowing heaven and earth, not doing no proper investment?
Right.
So for me, I'll sum it up like, we have done a collateral damage to the country. Now nobody wants to syndicate cocoa. And yesterday I heard the people are charging 9.5% for the 900 million. People don't even want to participate in cocoa syndication.
Right.
Collateral damage is so much. So I believe that as a nation, we should be looking forward where we leave things for the generations to come.
Okay.
Not to dissipate everything and destroy it. Dissipate and destroy. Not dissipate alone, destroy it.
Okay.
And then we say we are leaving a country. That is what I will say for the time being.
Dr. Tuahene, thank you. Those will be your final comments, actually, as we wind down on the conversation. Professor Mensah, dissipate and destroy. Those are the words of Dr. Tuahene, that we've ruined everything, collateral damage. What then would you say is the way forward, Professor Mensah?
Yeah, I think from where I sit, I've been saying this, and I'll keep on saying. Let's ring-fence our, existing debt, which has become albatross on us. And going forward, if I'm looking at things, we should be able to borrow for a purpose. And borrow for a purpose means that if you take foreign, funds, which in a form of borrowing, you should be able to invest it in, export-enhanced, projects, which at the end of the day will bring in, the foreign, currency to pay. I always take my mind back the first time we went to the Eurobond market, apart from those bilateral debt that we're accumulating. Our first commercial loan that we took from the Eurobond market, what did you do with it? Subsequent to that, if you study all the prospectus that we've used in going to the market, we borrowed to offset existing debt. So you ask yourself, which sector did we invested the first, Eurobond money that we got from the market in 2007? Clearly, we cannot pinpoint anything, and it has been a problem. And let me chip in this. You see, our generation, including Dr. Tuahene's age and Dr. Edu Entry's age, I think we've been, excuse my language to say, we've not helped this nation, because the generation before their generation, at least we can pinpoint something like Akosombo Dam, right, which has serviced this nation. The debt that we've been accumulating, what can we pinpoint and say this is a project that is going to pay our debt in the future?
But every time we get on that trajectory, I know we are ending. Every time we get on that trajectory, we are told free SHS, 1D, 1F, planting for food and jobs. So let me put it to you.
You see, free SHS is a social project, and when you are valuing a social project, this is a commercial loan. You see, when you compare, your commercial loan and you relate it to free SHS, you are getting it wrong. Okay. You can tax your own people to finance free SHS. You can use some resources like petroleum resources to finance, free SHS, but not, commercial loan that you're supposed to pay within a certain time bound. I'm talking about commercial loans that has gone into commercial projects that can generate the necessary revenue to pay back. So more or less a self-financing project that you put the money into. we cannot pinpoint anything. So we seem to be like, sometimes I walk and then I look at my kids and then I ask myself, would my kids, classify me to be an old man who has made impact on this nation? And I know that I can't give them any good answer. So from where I sit, our generation, including, Dr. Tiahire and then Dr. Edwin and Nientri, and all of us, we've been a bunch of criminals that we borrowed and then we've consumed without leaving anything behind for our, young ones. So the going forward will be that let's ring fence, the existing debt, but then going forward, we borrow responsibly. That is what I would say.
Thank you. Dr. Edwin and Nientri,
I'm not cutting it. You mentioned free high school, and I just wanted to ask.
No, I just threw that in, Doc. I threw that in because usually
how many of the ministers' sons or daughters attend the free high school? Let's be realistic. We must be looking for quality, not quantity.
All right.
I think we must make it very clear.
All right.
We should be talking about quality, not
Doc,
quantity.
thank you. Thank you for that final point. I only threw it in because usually when you talk about these things and you ask, where has all the money gone? Then you'll be told. I mean, recently we had Dr. Mustafa Abdul Hamid, who famously cried in 2016 about saving the soul of the country. When he was asked about whether they had rescued the country, that was what he used. He used free SHS.
You can't use free SHS.
Exactly. So that was why I just brought it up to find out whether it would measure up. Dr. Edu Ananientri, if you can manage 30 seconds with your final words, I'd be grateful, sir. Dr. Edu Ananientri. All right.
My advice is that government should try and do the needful by ensuring that it can bring its borrowing costs down. And I believe if the ministry sits with the primary dealers, they would agree that we are not going to bid at that high level and bring the prices, the cost of borrowing down, so that government can continue to do what is needed in this country. The borrowing cost is too high, and something must be done to bring it down.
Thank you so much, gentlemen, for having joined this crucial conversation. Professor Lord Mensah, Associate Professor of Finance at the University of Ghana Business School, Dr. Richmond Etuahene, Banking Consultant, Dr. Saad Idrisu, Economist, Louisiana Economic Development, and Dr. Edu Ananientri, Convener, Pensioner Bondholders Forum. Let me just cap it off in the studio with you, Isaac Ofie-J. What would be your assessment, your final words on the back of this conversation we've had?
Well, I think everything is actually contained in the research paper, which will be made available on myjournline.com right after this show.
Right.
And then also, we probably will be bringing you the part 3 of A Nation That Begs, which will not really focus on the DDEP because we said a lot about it, but also the external debt, how Ghana was hailed as the trailblazer or the darling boy in the Eurobond.
We're still the trailblazer. For negative reasons.
So we'll look at how Ghana actually moved from the darling boy in the Eurobond market, borrowing all over the place,
to the villain, the bad boy.
Right now, we are all over the place begging for debt relief and forgiveness and haircuts. And so that will be the part 3 of A Nation That Begs. But lessons from the DDEP will be made available on myjournline.com, a research led by Dr. Richmond Etuahene.
Isaac Ofie-J, thank you so much. He's a data analyst, our in-house statistician, if you like. And by the way, your haircut doesn't look like you are doing too badly. A nice haircut.
You mean the other haircut? Or
no, I mean this haircut, not the DDEP. Stay with us. We'll be back on the AM show with a lot more. That talk about lithium mining, the Abuache, the sacred forest or grove, if you like, among other matters. All of those we have coming up in a bit on the AM show. We'll be right back.